a concise approach to top-down market strategies and the forces affecting investments. That's the spoken word on investing.
Let's get the spoken word now on oil and what it's doing to the stock market and whether or not it can cause a recession. From our chief equity strategist, John Blank, who joins me via Skype. John, first of all, oil prices falling, really hammering stocks in the stock market. How long do you expect this to go on?
Well, Terry, we're also seeing today the newest announcement on oil inventory is falling and the oil price is getting back towards $30. And I'll throw out a fact that is relatively new, which is the trade numbers came out for the United States. And we took the first quarter of GDP growth from 1.2 to 2.5 because now we're not paying so much for importing oil. So we're now seeing almost certainly not a recession until the second half of this year. There's certainly none now. And then the question is, what do we have as a feedback loop with the stock market? Because the stock market is down from 2,100 to something below 1,900, so a 10 or 12% move. What I'll tell you, Terry, is we usually see, as economists, a 20 to 1, what's called a marginal propensity to consume out of stock wealth. So the bottom line with this is that a 20% move down in stocks gives you a 1% lower growth rate. And so if we have a 10% move down like we have now, it's a 1% or a 0.5% move down in growth. So the bottom line is, at this point in time, unless the stock market gets a lot worse than it has, this economy is fine. We're going to stay out of a recession. But what's going on here is a short trade. And people are shorting the S&P as long as oil goes down. So that technical trade pattern has to distort itself, break up, and don't count on it hanging on around forever. It's been here for a while, but don't count on it forever, Terry.
All right, so let's take it one step at a time. First, let's stick with the stock market. Is this a bull market correction, or is this the beginning of the bear, or technical trading?
Terry, there's two camps right now. I personally am in the camp of a correction that has played out through an earnings recession that has gone on 3 quarters and is likely to go on for a 4th quarter. There's another group that believes that the feedback loops on the stock market is going to take down the economy further, and that there's going to be a negative feedback loop. So there's 2 camps right now. Those are the bulls and the bears at this point in time. And it's really now, it's a matter of whether the bargain hunting comes in, people buy the stocks on the come that the earnings recession plays out now, and the second quarter of 2016 gets positive or at least flat, and we come out of this. So it all comes back to the oil price because that's what's driving the earnings change in the S&P 500. So you can't do anything but wait for the oil prices to stabilize, then hope for the forward look, and people start buying stocks. Now, the other way that this can play out is people don't. The shorts get greedier, they get tougher, they push stocks down more, and it creates panic. And that's the other way to go and look at this.
At this point, though, you feel the S&P 500 is fairly valued, right?
S&P 500, if you just do the math, Terry, on the latest numbers, 2016 S&P numbers 124, 16 forward P, which is, well valued but not overvalued, you're going to get an 1870 number, which is basically what we're trading today. So what you've learned from this correction is a very rational correction so far. And that's the language. So far, earnings have fallen and stocks have gone down in a rational level of expectations based on earnings. It's from here that people are confused. Does fear take over and we go lower, or does rationality and a forward look take us higher? That's the big argument right now.
All right, and today, just for people following on the calendar, February the 10th is when we're talking about this. All right, so lower oil prices not causing a recession.
There is absolutely no way oil prices can cause a recession, Terry. That is a mathematical fact. You can't even argue that. I want to take that off the table. And the reason is, if you look at the GDP accounts for oil, the spending that is drawn from oil in the United States is 1.7% of GDP. So even if we have that, that's 0.8% of GDP. And by the way, as you remember back to my earlier comment on the GDP growth numbers, we net import oil, so it actually causes GDP growth to go up. So even if you factor in a supply shock into that number, you're still not able, because 1.7 is lower than 2.5. You cannot, and let me repeat that, you cannot mathematically have a recession from falling oil prices in the United States. However, if you are dependent on oil, if you're Canada, if you're Russia, and if you're Nigeria, these countries can and will and have suffered recessions. So the point is, oil dependence, when it gets to be a large concentrated play, it can cause recessions, but we are just simply not there anymore as an economy in the United States.
All right, let's talk sectors quickly here. You see good things for infotech, consumer discretionary, and utilities. You've got stocks in each of those categories.
That's correct. Infotech is still being strong, and the Internet of Things is still going strong, and you still have a play in NVIDIA. And I really like the chip semiconductors now because you have a fear-based sell-off. You've got some valuations coming into play. And this is the chip maker for the autonomous vehicles out there and all the other things that are really getting people excited. So this stock has got momentum if it comes back, and it's got a story, and it's got the Zacks rank that you want to play with, and then going up through the industry, semiconductors, through the top down infotech, this is the stock you want to own.
Okay, next one.
Next one would be Fuji Heavy Industries. What's going on in Japan right now is the sovereign wealth funds in Middle East are selling Japanese stocks because it's very liquid stock market. So when they're needing some money, they're selling stocks. So there's a bear market in Japan, but Fuji Heavy Industries is a Zacks #1 rank. So you're getting, again, a nice low value, and you're getting a stock where it has a duality that I really like. Most people don't understand. Fuji makes Subaru. It's an auto company. That's Subaru. It also has a huge division that's dedicated to making aircraft. So if you like the airlines right now and you think they're cash rich and they're going to keep on competing, and I think that's the right answer, then this company is in two very cyclical spots, and it's in a stock market that's sold off. And most people are thinking that after the sovereign wealth ones sell off their stocks in Japan, there's going to be a swift bounce back on Japanese stocks.
All right, I'm going to let you pronounce the last one so I don't mess it up.
Thanks, Terry. Veolia Environment. This is a water utility, but it's more than that, and that's why I like it. What it does is an all-in bundle of wastewater and tap water and all the garbage disposal, everything. They come into an area and they give you an all-in package. And with the concerns about the environment right now, this stock has been a very strong performer, and people really like the business model. So Veolia Environment, if you're looking for a more defensive play, which is entirely understandable in a situation like this, that's where you want to look to this stock, Veolia Environment.
All right, John, thanks for that. And there you have it. Spoken word on oil, stocks, and recession. Obviously not going to happen as far as being a result of lower oil prices. That's according to John. And with John, I'm Terry Ruffalo.